All right, in this video, you're going to learn everything that you need to know about getting a conventional loan in 2022. So one of the more frustrating or anxiety-inducing things in the home mortgage, buying a home process is figuring out which loan is going to be best for you. And there's four main types of loans. There's conventional, there's FHA, USDA, and VA. And you're going to learn in this video if conventional is the right option for you or not. Now, conventional tends to be the more what's seen as like the standard or more traditional loan option, and it's the most widely used. And conventional loans are going to be better for higher credit scores and minimal credit issues. So for most people, what this is going to look like is if you're at a 680 credit score or higher, conventional is likely going to be your best loan option. Now, conventional does go down to a minimum of a 620 credit score compared to other loans that go down to 580 or even 500. This does add a little bit more of a restriction, but 680 and higher is going to be your best bet for conventional. So when we're talking about conventional, it's usually somebody that doesn't have a lot of credit issues. Usually they have some money to be able to put down. However, this does create a myth that used to go around, and I still find comes up every once in a while, is that you need 20% down to get a conventional loan. Not true at all. The minimum down for a first-time home buyer is 3%. So 3% of the purchase price. For some people, this is 5% if you're not a first-time home buyer. Okay, you do not need 20%. I'll talk about why people talk about 20% here in an upcoming slide. So there are two main types of conventional loans. Conventional is just a type, all right? It's not a specific loan. All right, think of it just like a blanket terminology. There are two main government-sponsored enterprises. So basically think of them like companies that the government helps along a little bit that oversee the majority of the rules for conventional loans. These are Fannie Mae and Freddie Mac. We don't need to know too much about them, but basically understand that these are the organizations that make the rules for most conventional loans. Now, you can use this for a primary home, so a home that you're going to be moving into and living in for at least a year. Also a secondary home, think of something like an Airbnb or a vacation home that you're going to live in for part of the year, but rent out the rest. And then an investment, this would be that you're renting out long-term that you will not be in yourself. So what is conventional? Again, it's a type of loan offered by many different lenders. It's not just offered by one specific lender. And in fact, pretty much, I don't know of a lender that doesn't offer conventional loans. Okay, it comes in a few different varieties with a little rule differences. So for instance, there's things like Home Ready, Home Possible. There are standard loans. There's Home One, and I'll talk about that on some upcoming slides as well. But just be aware that what we're talking about here is kind of the main general rules of conventional, and there will be slight differences in between each of these different types of loans. And we talked about Fannie Mae and Freddie Mac already. For instance, this Home Ready is Fannie Mae's product. Home Possible is Freddie Mac's. They're both extremely similar, but they're just created by two different organizations. Now, with most conventional loans, when you get an approval, a mortgage approval, it's often given by a computer software that's called AUS. All right, this is an automated underwriting system. And what this is doing is it's basically taking your loan application, it's looking at your credit score, your income, your employment, and it's judging how risky it is to lend money to you. And it either gives you a thumbs up or a thumbs down. So either an approval or denial on your mortgage. So most conventional loans are going to be underwritten through this software that gives you an approval. So just keep that in mind as you're talking with a loan officer, that's what's happening on your loan application. It's not just some like Wizard of Oz person behind a curtain doing all this. Talk with your loan officer. They're there to help you, help guide you through this process in saying, what does the software want? And keep in mind too, that because this is software based for most approvals, that it can change. Like there, sometimes, 1 week, somebody with a 680 credit score with 5% down might have an easy time getting approved. And then a week later, that might become a little bit more difficult. And the underwriting software then might want to see extra money in your bank account to get that approval. All right. So things do change. Talk with your loan officer about that if you run into any issues. So with COVID, obviously a lot changed. And with lending, there were a lot of rules that were put in place because giving out money became more risky and lenders wanted to make it less risky. So there's some changes that have been a little more reversed since we're on what seems to be the back end of COVID at this point. So there used to be a lot of credit score overlays Overlays are when there are the base rules given out by Fannie Mae and Freddie Mac, and then lenders can actually tighten those down a little bit. They can make them more strict if they'd like to. It's called a lender overlay. So there were a lot of lenders who had overlays of a 640 minimum. It appears that those are disappearing for a lot of lenders. However, that still might be the case for some. Also for self-employment, what you needed was a year-to-date profit and loss. If it was unaudited, you need 3 bank statements showing your self-employment income. So that right now for a lot of lenders is still in place. Future employment is now allowed. For a while that was being paused just because of a lot of layoffs and furloughs that were happening with COVID. And then we've also got some additional guidance from Fannie Mae and Freddie Mac about traveling nurses, because that has been a lot more common since COVID. And what you need here, if you are a traveling nurse, is 1 year minimum with previous nursing experience. So that's 1 year minimum traveling nursing experience with previous non-traveling nursing experience. I know that can be a little tricky here. Basically, what this is preventing is somebody who, as a nurse, maybe you used to make $80,000, and all of a sudden now you're making $8,000 per month. You can't just use the $8,000 per month. And I know some nurses who are doing that. You can't use that to buy a house because that income is not stable. You need to have a history of earning that income for at least 1 year with previous nursing experience. Okay? So I know that doesn't apply to everybody, but now let's talk about some down payments. This is where a lot of confusion happens for conventional loans. Again, we talked about the 20% myth. So if you're a first-time home buyer, you can put a minimum of 3% down. All right. And so a first-time home buyer means that you haven't been on title to a home in the past 3 years. All right. So if you're applying with 2 people, only 1 person has to be a first-time home buyer. Now, if you are a second-time buyer, it's 5% down as the minimum. All right. Now, there is one stipulation to this. Even if you're a second-time buyer, if you qualify for a Home Ready or Home Possible loan, then you can still do 3% down. Home Ready and Home Possible, I'll talk about in an upcoming slide, does have an income limit though. So you can do 3% down as a second-time home buyer, but you have to be under this income limit and qualify at Home Ready and Home Possible. So again, 5% down for all others. And if you're in what's called a high balance area. Now, I do have a link to this map, and this is the conforming loan limit map given by FHFA. This is basically showing all of the areas that are what are called high balance. So conventional loans have a loan limit, but you can go above the loan limit. I'll talk about that in an upcoming slide. I know I keep saying that. Unfortunately, mortgage guidelines can be a little confusing. So that's why we're here talking about them. So these areas here are these high balance areas. All throughout here, you can do 3% down, everything in the gray. Right here, everything that's colored in needs 5% down as a minimum. Okay, if you're buying a secondary home, 10% down. If you're buying an investment, it's 15% down. Some lenders have overlays that brings up to 20% down. If you have multiple units, so you're looking at a 2 to 4 unit home, that down payment will increase. So for instance, on a 4-unit home, that is going to be an investment property, you're going to need to put 25% down. However, if it's a single unit home that's an investment property, you can do 15% down. Okay, I know this gets tricky, hang in there. 20% down, this is where this myth comes from. When you put 20% down on a home, whether it's a primary residence, secondary, or investment, you can remove private mortgage insurance. Private mortgage insurance is a fee that you pay to the lender. It protects their interest in the home. If you ever stop paying, it's insurance for them, but you have to pay the cost of that, okay? So this is just a quick illustration of if you had 3% down, which would be the equity that you have in a home versus the loan balance. Keep in mind, you can always put more down than the minimum if you want to. The more money you put down, the more you're going to save by reducing interest. It's also going to lower your monthly payment. Okay. Now, a quick aside, you can see this gets complex as you look through loans, and it's really helpful to begin looking at building a team that's going to help you through this process. And so if you're looking for an introduction to a helpful loan officer or a helpful real estate agent, I can help you out. I have a link in the description if you would like to get connected with a helpful expert in your area. So you can go to winthehouseyoulove.com/lender to be introduced to a helpful loan officer, or winthehouseyoulove.com/agent to be introduced to a helpful real estate agent. All right, so conventional loans have two options that are called affordable options, and these are Home Ready and Home Possible, like I mentioned a little bit earlier. Basically, there's two programs offered by Fannie Mae and Freddie Mac, and they do have an income limit, but often what they do is they tend to have a lower rate and lower private mortgage insurance. And so Fannie Mae and Freddie Mac have said these are for credit-worthy, low-income borrowers, and I'll talk about the income limit here in just a minute, but this does allow 3% down, even if you're not a first-time homebuyer. It does have lower rates. It does have lower private mortgage insurance than a standard conventional loan. Again, we don't have to be a first-time homebuyer. The income limit is 80% of the area median income. The way that you can find that is you can either look at the link in the description. I'll have that here, or you can just Google Fannie Mae area median income lookup tool. That's not a mouthful at all. Basically, you can zoom into your area. So let's say that we were buying here near me in, let's say, Kettering. We click on it. It's going to show us the area median income. Here's the Home Ready income limit, 80% of the area median income. So if you make more than this, and that's the people who are going to be on the loan. If the people on the loan make more than this, then you will not qualify for a Home Ready or Home Possible loan. Okay, so it's something to check out. If you are under that income limit, then this might be a really good option for you. Okay, now something interesting here is that if you use one of these programs, Home Ready or Home Possible, and often if you put less than 5% down with a lot of lenders, you will have to take a easy but annoying course. It's like a home ownership course. Could be really helpful in understanding a lot of the process. If you're watching this video, you're probably a step ahead of the curve. Closing costs. These are going to be the same as other loans. Okay, conventional doesn't have any like specific closing costs that are specific to it. Like an FHA loan has upfront mortgage insurance that's goes along with it. Same thing with USDA and VA loans. Conventional loans don't have any sort of specific fee with them. You do have the option to waive escrows at 20% down. Escrows are basically a savings account for your taxes and insurance that are paid for upfront. Since things like taxes and insurance are usually paid semi-annually or annually, it's a savings account that you create when you close on a home so that there's money in there when the 6-month bill or the annual bill comes due. Now, you can waive this at 20% down. Some lenders will actually allow you to waive this at something like 5% down. Some may or may not require or charge a fee with waiving escrows. Talk to your loan officer about some options there. Now, your money for your down payment and closing costs do need to be verified with bank statements. Usually this is 2 months of bank statements. Also, you can use things like a gift fund from a family member or a 401k loan to prove that you have money for the down payment. Basically, your lender just wants to see if it's going to cost you $40,000 to buy a home or $20,000 or whatever it's going to cost, bottom line, to buy the home with your down payment and closing costs. They want to see where you got that money from. Credit score. All right, so let's talk about credit score minimums. Move this down just a touch here. So 620 is, 620 is the absolute minimum on a conventional loan. At 680 is where we tend to get better rates, and 740 is the top of the charts. You're not going to get any better benefit by having an 800 versus a 740. The chart just tops out. You did a good job. You can't do any better than that. Okay, so what I recommend to people is if you are above a 620, let's at least look at a conventional loan option. For most people in between 620 and 680, something like FHA or a non-conventional loan might be a better option because conventional loans tend to kind of penalize middle of the road credit scores. Conventional loans tend to really like the credit scores that are 700 and above, and anything less than that, we start to see some extra rate increases added to them. So if you're above a 620, it's definitely worth seeing if you can qualify for conventional and getting a quote for a rate. But absolutely, we want to compare that against something like an FHA loan. And I have a tool that helps you compare loans. That's the links in the description, called the Loan Clarity Advisor, that can help you with that as well. Of course, if you're in the 700s, conventional is almost always the best option for you, unless you're looking at a specific type of program like a VA loan program that allows 0% down if you are a veteran. Now, Fannie Mae, actually, let me back up really quickly. Here's how your credit score is determined for your loan. So let's say we had these three scores. We have a 780, a 716, and a 733. What lenders are going to do is they're going to look at your median score. So the middle score, we're going to throw out the lowest, throw out the highest, and use the 733 as your credit score. Okay? So that score in the middle. If two people are applying on a loan, what they're going to do is actually average the median scores. So they'll take your two median scores, average them together, and if that's above the 620 threshold, that doesn't look like a 620 at all, does it? If it's above the threshold, what it will then do is allow you to be eligible for that loan. It's not going to be the credit score used for your interest rate, and how they find the interest rate, it's only going to be used to see if you're above the 620 minimum, okay? Then what they're going to do is take the lowest of your median scores. That's going to be the score that's used to find your interest rate, okay? Your credit score on conventional loans heavily drives the interest rate that you get. The higher the credit score you have, the lower the interest rate. The lower credit score you have, the higher the interest rate, and private mortgage insurance as well, okay? 2-year history of credit is going to be the best. Rental history can now help on Fannie Mae loans. You do have to use a certain software that basically kind of analyzes your bank statements. So your loan officer can help you get connected with that if you'd like to. It can only help. It can't hurt if you refuse it. Okay, so if you say, I actually don't want to do that, it will in no way negatively impact your loan application. But if you're on the edge, it can help you qualify if you initially weren't going to be able to get an approval from the underwriting software. Conventional loans do have the option, if you have no credit score at all, to use what's called manual underwriting. And this is where they can look at things like utility statements and bills to build kind of a pseudo credit score. Now, no credit is completely different than bad credit. Bad credit will not work on a conventional loan, but if you have no credit score, then a manual underwrite can work. All right. So here are credit events. These are basically kind of big things that take a hit to our credit score. How much distance do we need between the time of the event and the time that we can close on a conventional loan? If you had a deed in lieu or a short sale, you're going to need to wait 4 years from the transfer of the deed to the time that you close on a conventional loan. If you had a foreclosure, it's going to be 7 years. A Chapter 7 bankruptcy is 4 years waiting period. For Chapter 13, 4 years after dismissal, 2 years after discharge. And IRS liens, you need to have a payment plan for those, and that payment plan needs to be included in the debt to income ratio. This is going to change your affordability with how much you can qualify for, what kind of loan you can get, and ultimately how large of a house can you purchase with a conventional loan. Interest rates. All right, so let's take a look at interest rates really quickly for conventional loans. This is obviously at the time of recording of this video. Every once in a while, I get comments from people who are watch a video like 2 years ago, and they're like, "This isn't current." Like, yeah, it was recorded 2 years ago. What do you want me to do about that? I can't change it. So you can go to winthehouseyoulove.com/rates. Right now, conforming, this is a conventional loan, 5.4%. We can look at rate trends if I want to turn off all of these other loans. This is a 15-year versus a 30-year, 5.4 versus a 4.5 for these loans here. There's been a change to conventional loans where high balance loans, like we talked about, that require the 5% down, now are actually going to be more expensive along with second homes, okay? And so these are the differences in the fee costs, so the actual closing costs of these loans. Think of it like a point charge. It's kind of like prepaid interest. Fannie Mae and Freddie Mac have made buying a high balance home and a second home more expensive to try to reduce some of the competition in home buying. It's unclear how well that's working so far, but just be aware if you're buying a home in a high balance area or a secondary home, the interest rate is going to be significantly higher than if you buy a primary residence home. 3% down usually has a higher interest rate than 5% down. If you have the flexibility with your down payment, if you're looking at, hey, we want to do something like 20% down, ask your loan officer, can you give me a quote for 3%, 5%, 10%, 15, and 20, and see what the difference in interest rate looks like. Now, conventional loans usually have a higher interest rate than government loans. like FHA, VA, and USDA. However, the mortgage insurance is lower on conventional loans most of the time, and usually it's a better option. And we're going to walk through a cost example here in just a little bit so you can see what the difference looks like, because sometimes the lowest rate isn't the best option. Also something to be aware of, especially as our interest rate environment is changing. We were looking at like historically low interest rates that we hadn't seen before. Now interest rates are in the 5-ish, low 5 to mid 5% range. Adjustable rate mortgages are becoming slightly more interesting. And this is where instead of a fixed rate loan where your interest rate is fixed over 30 years, an adjustable rate loan only has a short fixed period, and then it can adjust every year, or most of the time every year after that. So maybe in the first 5 years, it's 5%, and every year after that, it can change. So that's something to be aware of, and maybe talk to your loan officer about some options there. Okay, so now let's talk about mortgage insurance. There's no upfront mortgage insurance like there is with some government loans. So private mortgage insurance is required if you put less than 20% down. Here's something that a lot of people mess up. They think that as soon as they have 20% equity in the home, so let's say that you put 5% down, and over the next, let's say 8 years, you're paying in principal to your mortgage and you get to 20% equity. It doesn't immediately fall off. At 20%, you have to actually request it to come off. And sometimes the lender requires an appraisal to verify that the value of your home didn't decrease. At 22%, it automatically falls off. So just be aware of that. At 20%, you can ask for it to come off. At 22%, it automatically falls off. Okay. Now, conventional loans are often commonly used, they're refinanced into to remove mortgage insurance from something like an FHA loan. FHA has a really high mortgage insurance monthly that can cost several $100s per month. So what a lot of people will do is maybe they can only qualify for an FHA loan in the beginning, but then they refinance into a conventional loan to lower the mortgage insurance. Conventional loans are also interesting in that the PMI is based on the risk of the loan. So the higher your credit score is, the lower the mortgage insurance is because it's less risky of a loan. The lower your credit score is, the higher your mortgage insurance is going to be. And there's a lot of other factors that impact your PMI rate as well. So a quick example, let's say we're looking at a $400,000 home with $380,000 loan. PMI ranges all over the place. Think of it in the same way that you would shop for lenders. There's all different types of PMI. There's no one standard thing. However, it's usually between 0.5% and 1% of the loan amount. So 0.5% would be $158 per month. 1% would be $316 per month. I like to use as just an average for most people of 0.6%, which would be $190 per month on a $380,000 loan. Again, this can change often. It's a lot lower, but I think this is a really good rough estimate for just adding some extra padding to make sure that we're comfortable with the payment. Okay, property requirements. So if you are going to be living in the home, which most people watching this video probably are, you're going to be moving into the home, living in there. You need to move in within 60 days. The minimum occupancy before you choose to rent it out is 1 year. So the way that this works is if you're saying, I want to buy the home as a primary residence, and then I want to move out, rent it, and buy another home, the minimum time that you have to live in there is 1 year. As long as you do that, you don't have to refinance it into an investment loan. If you buy it 6 months from now, you want to rent it out, you have to refinance it into an investment loan. There's always comments that are like, yeah, but how are they going to know? I'm not going to tell you how to commit occupancy fraud. Please don't do it. I don't suggest it. There's plenty of software that can understand when people are doing this. So just be aware they do check. Minimum occupancy time to sell, though, is none. You can sell it at any time. So if you move into the home and then a month from now you want to sell it, absolutely you can do that. No problem at all. Secondary home, you can use something like an Airbnb. You can choose to live in there for a period of the year and then rent it out the rest of the time. Also, you can use it as an investment property where it's just rented, and you can also buy homes that are 2 to 4 units. Okay, now we talk about the appraisal. The appraisal is where the lender needs to justify the value of the home. That way, when you ask the lender, hey, can you give me $400,000 for the home? They're like, yeah, it's actually worth $400,000. They don't want to give you $400,000 and the home is only worth $200,000. So conventional loans are easiest to get as is, so it's best for foreclosures. Basically what this means is conventional tends to be the most lenient of the main types of loans in allowing things to be in somewhat of a state of disrepair. Whereas like FHA loans can be really strict about the requirements, Fannie Mae is a little bit more lax. So this is transferable from other lenders. So if you got an appraisal with lender A and then all of a sudden you want to switch to lender B, you can transfer that from lender A to lender B as long as lender B is okay with that, okay? So conventional loans, Fannie Mae and Freddie Mac don't have an issue with that, but your lender may or may not allow that. That would be an overlay. You just want to check with them. Fannie Mae is slightly more lenient in their appraisal standards. And what's really important to understand here is that it permits the appraisal to be based on the as-is condition of the property, provided existing conditions are minor and do not affect the safety, soundness, or structural integrity of the property. All right. And I'm going to walk through kind of what are some of those issues right here. But really quickly, what's really interesting about conventional loans is they allow desktop appraisals and waivers. So normally an appraisal is where an appraiser is going to come out to a house. They're going to actually walk through the outside and the inside. And then as COVID hit, there was a lot of changes to appraisals where lenders were allowing more desktop appraisals. And this is where a lender may or may not just look at the outside of the home. They may actually do a video, like a live video walkthrough of the inside of the home. And often what they'll do is they'll use computer models and software to figure out and justify the value of the home just based on data. Some people love this. Some people hate this. I'm just telling you what exists. So desktop appraisals, usually this is only available if you're buying a home with one unit and often with 10% down. Now there have been some COVID loosening of standards that have allowed people to get desktop appraisals even without having the 10% down. Now, you can also get an appraisal waiver, and this would be where an appraisal isn't needed at all. So basically the underwriting software says, hey, we actually have enough data to support the value of this home. So you want to buy it at $400,000. We have enough data to support that. We don't actually need any appraisal. Fannie Mae calls this an appraisal waiver, and Freddie Mac calls this automated collateral evaluation. I don't know. So usually this is only available for primary one unit, 20% down, and a really high credit score. Expect somewhere in the 720 and higher range. So here's some appraisal issues that conventional loans do not like. One is active roof leaks, water seepage or significant plumbing leaks, uncapped wiring, curled, cupped, or missing roof shingles, damaged or failing foundations, mechanical system where it's apparent it has exceeded its expected life, or mechanical systems that are non-functional, and sanitary system with evidence of failure. I really need to spell check these slides before I send them out. So if these are issues, likely it's going to be flagged in a conventional appraisal, meaning that it likely needs to be fixed before you can close on that loan. Okay, now let's run through some example homes. I think this is really helpful just to see a general idea of monthly payments, potential upfront costs. So just keep in mind, this is all information based on public data at the time of recording, and these are all just based on averages. So things like interest rates and closing costs are just averages. These are not quotes available directly to you from me. Okay, so this is a home here that I found online listed in Columbus, which is like an hour away from me, for $465. This is a 2-bed, 3-bath. It's a really nice updated home. We can get this for 3% down, which is going to be $14,000. Estimated closing costs probably going to be somewhere around $9,300. Okay, and here's a breakdown of the monthly payment. So we have principal and interest, the mortgage insurance, and this would actually be PMI instead of MIP, private mortgage insurance, the taxes, homeowners insurance, homeowners association fees, and the monthly payment for this, if we did 3% down, would be $3,850 per month. Okay, let's look at an example 2. This is a home in Dayton. This is the city I live in. $210,000, 4-bedroom, 2-bath. really nice home. Nothing too crazy, right? It's not this massive mansion, but it's really affordable. 3% down, $6,200. Estimated closing costs would put you somewhere around $4,200 there. Principal and interest would be around $1,000 per month. Mortgage insurance, again, this would be PMI, not MIP, $100 per month. Taxes, $380. Insurance, $78. HOA, 0. This would put you about $1,653 per month for this home here in Dayton. And then you get to live close to me. That maybe that's a win. Maybe that's a loss in your book. I don't know. So loan limits in 2021, the loan limit was $548,250. We've had an 18% increase to this year of $647,200. This is the maximum loan that you can get in the most of that. When we looked at that map, that was that gray area. Let me come back to this so you can see it. Right? In all these areas, this is what the loan limit is. If you're buying in somewhere like Davidson County, what's going on here? What's going on with our map? Then it becomes $694,600 as the loan limit. If you're looking at buying somewhere in, this website is kind of garbage to use. California, Santa Clara County, California, the loan limit is $970,800. So that does change depending on where you're at. The maximum price with 3% down, not in those high cost areas, went from $565,000 to $667,216 with 3% down. Of course, if you put more as a down payment, that will increase the maximum purchase price that you can have. Okay. Remember, 3% down, 5% down in high cost areas. Now for income and employment, you need 2 years stable history. This does not have to be at one specific job. This is just a 2-year history, not at one specific place. It's ideal to be in a similar field if you are changing jobs. And retirement does count as employment on a loan application. I know this sometimes trips people up, but if you're retired, it's perfectly fine. You can still get a loan based on things like your pension income, or maybe you have a side job or Social Security or whatever income you're getting, distributions, things like that. Frequent changes in the same line of work are okay as well. So think things like temp jobs. Even if you have a history of doing temp jobs over the past 2 years and flipping, that actually still works as long as you have consistent income. Okay, affordability. This is all determined by a formula called the debt to income ratio. This is the debt that you have divided by your gross monthly income. Yes, lenders use gross monthly income. I know that's not what hits your bank account. That is what they use, though. Every single lender in the US uses your gross monthly income. All right. Some loans have what's called a front end ratio. Conventional loans don't have it, so we're not going to worry about talking about it. We're going to scratch this out. They have what's called a back end debt to income ratio. So this is your total debt divided by your monthly gross income. All right. So your total debt is going to be everything that is a minimum debt payment. So think of things like credit cards, car loans, student loans, personal loans, child support, and alimony do count. Things that do not count as debt are things like your rent, your gas, your groceries, your utility bills. Those are not debts. Those are expenses. We only want to count our debts in here. Okay. Now, this goes up to 49.99%, meaning that if you, let me pull up my screen here for a second. Meaning that let's say you make, let's say household income, right? Household income of $100,000 per year. We divide that by 12. That's 33 per month times 0.499. We can have a maximum amount of debt plus a future household payment. Those added together cannot go above $4,165 per month. Okay. So not everybody can get approved this high. All right. Please keep this in mind. This is just the maximum that we've seen. Remember, the software is going to give the ultimate approval here. So the lower your credit score is, the lower that debt to income maximum is going to be for you. Fannie Mae, Freddie Mac do not publish these exact numbers, and they actually can change week to week very slightly. So that's not going to be published. These are just the maximums that we see. So keep that in mind. So if you go to a loan officer and like, well, no, the video said it was 49.99%. That's just the maximum that's usually only offered to the least risky buyers, the most well-qualified buyers. If you're in a situation where you have a lower credit score or less money or less down payment, then you're usually likely not going to see a debt to income ratio that's that high. Community property is not a factor in other loans. Sometimes your spouse's debts have to be included. With conventional loans, they do not. So let's run through some examples. If we have $50,000 per year income, and this can be either you as an individual or household, okay, however many people are on the loan, if you have zero debt, the maximum housing payment would be $2,082 per month. Okay, and this is the absolute maximum. We're assuming we have a super good credit score here. If we have $750 per month in debt, it's $1,332. If you have $100,000 income, again, that can be household income, zero debt, $4,165 is the maximum housing payment. And this has to be your principal, interest, taxes, homeowner's insurance, all combined. It cannot exceed that number. If you have $750 per month in minimum debt payments, then that's going to drop to $3,415 per month. Okay. Now, one quick thing is I do have a calculator here that I call the max purchase price calculator. What this is going to do is help you with some of the debt to income math. And so instead of having to figure that out on your own, it's going to walk you through all of that. So you can come in here and put in maybe 3% down. Interest rates are looking a little bit higher here. Fill out things like your gross yearly gross income, how much debt you pay, and maybe a co-borrower on the loan, and show you how much you likely would be approved for based on what you entered. And you can play around with this and see different risk levels along with this too. So the link is in the description if you are interested in that helping you out. Now, student loans, these can trip up a lot of people with getting a mortgage because it's a lot of debt and a huge monthly payment that can impact your affordability. So this is where we see some big differences between Fannie Mae and Freddie Mac. Fannie Mae, and you can talk to your loan officer about, hey, what GSE, the government-sponsored enterprise, what are we going to use, Fannie Mae or Freddie Mac? And they can also help strategize which one you're going to use depending on which is going to be easiest for you to qualify with. So Fannie Mae is going to either look at the minimum payment that you pay on your student loans, or if they're deferred, they're going to use 1% of the balance as your monthly payment and include that in your debt to income ratio, right? We talked about that $750 per month in minimum debt payments. That's going to be added into whatever your minimum debt payments are. If you're on income-driven repayment, it is allowed. This is a really big win because if you're on an IDR payment at $0 per month, Fannie Mae is going to be great for you. With Freddie Mac, they're going to look at the minimum or 0.5% if it's zero or deferred. So with Freddie Mac, if you have a $0 per month IDR, they're actually going to default to 0.5% of the balance as your monthly payment here. Okay. IDR is allowed if it's above zero. So if you're on an income driven, let's say your normal student payment is going to be $200 per month. Okay. And that's on IDR, let's say that's down to $50 per month. It's allowed on both Fannie Mae and Freddie Mac. If it goes down to zero, that's only going to be allowed on Fannie Mae. Okay, so for instance, let's say we have a $45,000 student loan on income-based repayment at $0 per month. Fannie Mae is going to accept $0 per month. Freddie Mac is going to take 0.5% of the balance as your monthly payment. That means your affordability, how much home you can afford, is going to be reduced by $225 per month. Seller credits. All loans allow you to ask the seller for a percentage of the purchase price back as a closing cost credit. This can help offset some of the upfront costs. With conventional loans, this is actually dependent on how much money you put down. If you have less than a 10% down payment, the maximum you can ask for is 3% of the purchase price. So for a $200,000 home, that's $6,000 that you can ask back. Something to keep in mind is that the more seller credits you ask for, the less competitive your offer becomes. If you have 10% down, 6% is the maximum you can ask for. 25% down or higher, 9%. And on investment properties, the maximum is 2%. So for an example, if we're looking at a $425,000 house with 5% down, the maximum credit we can ask for is $12,750 towards our closing costs, which is 3%. Again, keep in mind, the seller doesn't want to pay most of the time the extra $12,000 if another offer comes in that isn't requesting seller concessions. So you want to talk with your realtor about how this is going to impact your offer if you ask for seller concessions in your offer. So some special requirements, features here that are just a little bit more unique to conventional loans is number one, they're easier for foreclosed homes. They allow things like desktop appraisals. They can allow appraisal waivers. One really interesting thing here is you can get a second appraisal if you need to. So for instance, let's say you put an offer in on a home and it came in short. So maybe you bought the home, you put in an offer for $400,000 and you got an appraisal with lender A and it came in at $380,000. And you really don't want to have to bring an extra $20,000 to the closing table and the seller won't budge. You can actually go to another lender, let's say lender B, and have them do a second appraisal. Now, it doesn't mean that that's going to come in at the value that you want to. It may come in even lower, but it is an option that you have on conventional loans that you don't have with other types of loans. There also are rehab loans. So things like a home style renovation loan is an option. You want to work with a lender who specializes in conventional rehab loans if you are going to do something like that though. Okay, now for some refinancing options with conventional loans. So just something to keep in mind as you get a loan, you may want to refinance into something like a lower rate in the future, or you may want to pull cash out of your home of the equity that you have. Maybe you have $50,000 in equity that you want to pull some of that out to help pay off debt or go towards maybe a college fund or something like that. So for conventional loans, there's no streamlined options. Other loans have the option to refinance into a lower rate without having to look at a new appraisal or look at your income or your credit. Unfortunately, there's not an option like that with conventional loans. You have to have a new appraisal, new income, and new credit underwriting. So we have to go through the whole underwriting process again. There are two different refinance options. There's a limited cash out refinance, which used to be called a rate and term refinance. This is where most people will adjust, like it's called the rate and term. I don't know why it's dumb that they changed the name because rate and term made sense because that's what you were changing. This would be like if you were in a 6% interest rate and all of a sudden interest rates drop to 3%, which they did a year, 2 years ago. This is where you can do a refinance to get a lower interest rate and save a lot of money on interest. A cash out refinance is where you actually pull money out. So you can actually refinance and get a lower interest rate if the interest rates in the market are lower and pull money out of your home that you have built up in equity. Okay, so let's talk about the success rate and the seller perception. When most people are talking about loans, they're talking about conventional loans. They're kind of seen as the standard option, the more traditional option with getting a loan. And they sometimes can be more preferable than cash if the offer price is higher. Now, this is going to depend on the local market that you're in, but sometimes what can happen is when people put in cash offers for a home, let's say a home is listed at $400,000, sometimes people with cash will put in an offer for $390,000. Now, we're in a really unique real estate market right now where that's not really the case. But historically, that often is the case where cash offers can come in at a lower discount because cash is a lot easier and sometimes more attractive to sellers. So what often can happen is a cash offer may come in at $390,000, but a conventional offer may come in at $400,000, and the seller may choose to go with a conventional loan because it's offering more, even though cash is a little bit quicker. So again, not always the case. We're in a very unique real estate market right now, and that likely might not be the case for you at the moment. Also, most people could benefit by raising their score to qualify conventional. So one really interesting thing to keep in mind here is that, especially as we're in this kind of really tough real estate market, is if right now you can't qualify conventional, please talk to your loan officer and say, hey, what do I need to do in the next 3 months, 6 months, 1 year, whatever it's going to take? What do I need to do to qualify for conventional? Because in a market like this, putting in an offer with something like FHA, USDA, and VA can struggle compare it to the other offers that are coming in that are likely conventional. Conventional is going to be your best bet, kind of putting your best foot forward to be able to get your offer accepted. So please ask your loan officer what you can do. Don't just get a no and then move on without seeing what else you can do there. So real quick cost comparison. I built this calculator called the Loan Clarity Advisor. And what this does is allows you to compare different loan options side by side. So we can look at loan scenarios, but then we can also look at comparing loan quotes side by side from different lenders, so you can choose the ones that can save you the most money. One quick example I wanted to run through here was, let's look at a $400,000 home. Zoom in here just a touch. And if we look at conventional versus FHA, let's do 3% down versus 3.5. That's the minimum on FHA, both of 30 years. Now, here's where the lower interest rate isn't always better, because on a conventional loan, let's say we get a 5% interest rate. Now, FHA loans often have a lower interest rate, but they have a lot higher mortgage insurance. So 4.625, this is going to, let's use an estimate here. So this is going to use that 0.6 number that we talked about earlier. So $194 per month in private mortgage insurance. The FHA mortgage insurance is automatically calculated, so it doesn't have an input here. Okay. If we looked at this over, let's say 6 years, even though the conventional loan had a higher interest rate, choosing this loan saves us $4,000. It's $4,000 cheaper over 6 years. If we look at 10, it's $2,000 cheaper, right? They actually kind of almost get close here as that FHA low interest rate starts catching up. But then all of a sudden, things change. It starts diverting. That conventional loan gets lower in cost. And that's because the mortgage insurance drops off at that 22% equity. If we look over 30 years, it's $17,000 cheaper. If we look at the monthly payment, here is our mortgage insurance, right? If we look at this through the years, at the beginning, $194 versus $271, because FHA has that higher mortgage insurance, but a lower interest rate. And if we look at this, keep an eye on the conventional mortgage insurance. That's actually going to go to 0. Looks at the end of year 9 is when that falls off and we hit that equity mark. Okay, so how do you get one? Ultimately, almost any lender can offer a conventional loan. Apply, ask the loan officer what you need to do to qualify for conventional if you don't qualify up front, okay? In this market, you likely want to work with a lender who can help you get as fast of a closing as possible. Conventional loans often can close in between 15 to 30 days. Just talk with your loan officer about what to expect here. That's going to help shape your offer. Again, if you need help, if you want to be introduced to a helpful professional who can walk you through some of the differences with conventional, help you compare loans, and find what's going to be the best for you, the link is in the description. As always, thank you so much for watching.